Hey everyone, welcome back to Corporate Decoded, the place where we decode the financial secrets that companies try to bury deep inside their filings. And let me tell you, Fortress Net Lease REIT has just dropped a report that might make you reach for your piggy bank, or maybe cheer it on, depending on how you look at it. So what is the big deal with this filing? It's a Form 8 cake, which is basically a report that companies have to file when something really important happens that investors should know about right away. Think of it as the company's way of shouting out significant news. Today we are diving into what's called a Fourth Amendment to a credit agreement. Now that sounds super boring, but it is actually a big deal, especially for a company like Fortress Net Lease REIT. This is all about how they are borrowing money. Essentially, FNLR OPLP, which is a borrower, along with the main company Fortress Net Lease REIT as a guarantor, agreed to some new terms on this loan. They've changed up the deal they had going on. The big news here is that they have significantly increased the total amount of money they can borrow. Imagine you have a flexible credit card, and suddenly they bumped up your limit. That's pretty much what happened. Their total borrowing power, called credit facilities, went up from a massive $1,275 million to a staggering $1,650 million. That is an increase of nearly $400 million. This kind of borrowing increase tells us they are either planning some big expansion or looking to refinance existing debts. Part of this increase is in their revolving credit facility. Think of this as a line of credit that they can draw from and pay back as needed. This part alone went up by $300 million. This gives them a lot more flexibility to manage their day-to-day operations or opportunistic investments. They also increased their term loan, which is typically a loan for a specific period. This portion increased by $75 million. They are definitely loading up on debt, which can be a smart move if they believe they can generate returns higher than the interest they pay. Here is something really interesting. They didn't just increase their borrowing limit now. They also expanded something called an accordion feature. This means they've potentially made it possible to borrow even more money in the future, up to a whopping $2.5 billion. This shows a real hunger for capital, suggesting ambitious growth plans or a strategy to maintain significant financial leverage. They've also added a new way to borrow money in different currencies like euros, British pounds, and Canadian dollars. This is a pretty smart move for a real estate investment trust that might have properties or tenants in other countries. It helps them manage currency exchange risks. They also temporarily increased how much they can borrow against their assets, called the borrowing base advance rate, from 60 to 65% until early 2026. This means they can borrow a larger chunk of the value of their properties in the short term. Now, a crucial piece of information is that these massive loans are unsecured. This means they are not backed by specific physical assets of the company. If worst comes to worst, lenders don't have a particular property they can easily seize. This usually means higher interest rates because it is riskier for the lenders. Let's talk about the cost of this money. The interest rates are tied to benchmarks like SOFR, which is like a widely used short-term interest rate. The extra charge on top of that, called a margin, ranges from 1.40% to 1.90%. These are not outrageously high, especially for unsecured debt, but they are definitely not cheap. They also have another option for interest rates, a base rate that can be even lower, with margins from 0.40% to 0.90%. This offers them flexibility to choose the cheaper option depending on market conditions. There is also a fee for the money they don't use in their revolving credit facility. This fee, ranging from 0.15% to 0.25%, is paid quarterly. It's a common practice to charge for keeping a line of credit available. Of course, with such large loans, there are strings attached. The company has to follow a bunch of rules called covenants. These include limits on how much more debt they can take on, restrictions on what they can do with their assets, and requirements to maintain certain financial health markers like specific ratios. And if they mess up and break these rules, or if they can't pay their debts, the lender can demand all the money back right away. This is a pretty standard clause for any large loan agreement. This item basically just tells us that the stuff we talked about in item 1.01, the new loan agreement, is a direct financial obligation for the company. Nothing really new here, just confirming it is official. This section is where they list all the documents that officially go with this report, so people can find the actual agreement if they want to read all the fine print. The most important exhibit here is Exhibit 10.1, which is the actual Fourth Amendment to the credit agreement itself. This is the master document that spells out all the nitty-gritty details of the new borrowing terms. And finally, the report is signed off by Avraham Dreyfus, the Chief Financial Officer. This means he has officially taken responsibility for the information presented here. So, what is the big picture here for Fortress Net Lease REIT? They're aggressively raising capital, significantly increasing their debt load to fuel potential growth or manage their portfolio. The unsecured nature of these loans means they're taking on more risk, but this is often a trade-off for flexibility and potentially cheaper borrowing costs if they can prove their creditworthiness. The expansion of their borrowing capacity, especially the multi-currency option, suggests a strategic move on a larger, possibly international, playing field. However, with great borrowing power comes great responsibility. They'll need to manage this debt carefully, ensuring their investments generate enough income to cover the interest payments and principal repayments. The covenants in the agreement will be key to watch. If they start bumping up against those financial ratio requirements, it could signal trouble. In my opinion, this move shows a company that is hungry and aiming for significant expansion. The strategy seems to be growth through leverage. The big risk is that if the economy turns sour, or if their property investments don't pan out as expected, this large debt burden could become quite heavy. They are betting on their ability to generate strong returns to service this debt. If they succeed, they could see significant gains. If they falter, the consequences could be severe. It is a high-stakes game they're playing. What is your take on Fortress Net Lease REIT's aggressive borrowing strategy? Do you think it's a sign of smart growth or a risky gamble? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and don't forget to subscribe for more decoding of your favorite companies. Also, we have a fantastic Discord community where we discuss these filings in real time. The link is in the description. Thanks for watching, and I'll see you in the next video.